Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There's been so much volatility on share markets lately, both here and overseas. Lockdowns, economies reopening, inflation fears, high energy prices, geopolitical tensions, Chinese property giants collapsing, they're all combining to make it a wild ride for investors. I wanted to speak to an expert today about the drivers of market movements, what the outlook is for equities, and where investors might find an opportunity or two. Kate Howitt has been managing the Fidelity Australian Opportunity Strategy since 2012, with more than $2 billion under management. The fund, which is part of Fidelity International, is a selection of between 40 and 70 Australian companies. Kate has been recognised 4 years in a row as one of the top 30 female fund managers in the world, the only Australian to make the list. Kate Howitt, welcome to Fear and Greed.
Great, thanks to be here.
So how do you characterise what's going on in equity markets? Every morning I talk about this, and there have been some pretty significant swings, particularly in recent weeks.
Well, we've had really strong rebound from the lows that we hit about 18 months ago when COVID really started to impact through to the world. So markets have been on a great run for over a year now, and they're starting to run out of puff. And so the question is whether that's just kind of taking a healthy pause to refresh, or whether the underlying drivers for the market are really starting to shift.
Okay, so when you talk about underlying drivers, you talk about fundamentals, flows and valuations, those three concepts. Can you just run through what you mean by it and where you see they are? So if we start with fundamentals.
Yeah, because mostly what I'm doing day to day running the opportunity strategy is looking for good individual companies. But you do every so often have to step back and say, where are markets now? Where are they headed? And I've just always found this a really good way to kind of break the question up. So what's going on with fundamentals? And really that comes down to our earnings and corporate cash flows, going up, or are they compressing from here? So what's the basic economic drivers of these businesses? Then you've got to ask yourself about the flows. So is money coming into the stock market? Or are people fearful and withdrawing money from the stock market? Because, share price is just like any other commodity. The price is going to be set by supply and demand. So if there's more demand than there is supply, the price is going to go up, and vice versa. So it's actually important to step back and kind of look at the context of the equity market. And then valuations are also part of the equation, because if things are being offered at a rock bottom price, they're more attractive, people are more likely to buy, and they've got more room to move upwards. Whereas if valuations are more stretched, then that's going to make people a bit more hesitant and put a bit of a cap on how far markets can go. So if you can kind of get your head around those three aspects, you can generally get a bit of a read on whether markets are poised to really perform strongly or weakly, or maybe somewhere in between. So if we think about where we are now, the fundamentals, I would kind of characterize this as we're moving into the phase of learning to live with COVID. And we're seeing this at the national level with various governments adjusting their strategies from, an elimination type strategy to an accommodation strategy. And that's really been enabled by vaccines and the strong rollout that we've had in vaccines. And so that is then rippling through to individuals, corporates, having to adjust their business models to reopen, but in a way that's slightly different than where we were before the pandemic hit. If you think about flows, we've had enormous flows into equity markets, and this is on the back of the enormous money creation and stimulatory policies that we've had from most major central banks and governments around the world. And so there was a very big stimulus put into the global economy to offset the slowdown and shutdown impacts of the pandemic. And so that's created a lot of money looking for a home. And, that money is flowing into, you can see it in the property market, you see it in the stock market. A lot of major asset classes have really done well. We haven't been able to spend our money on, going on a holiday or getting a haircut, but, we're able to go out there and buy some assets. And the valuations are stretched in some areas of the market and really quite reasonable in others. So it's a bit of a mixed bag on the valuation side.
So just on valuation, you hear a lot of people discussing, sure, valuations are stretched, but what's your alternate? Because bond rates are so low. How's that fit into it?
Yeah, and this kind of circles back to the question about flows also. And so one of the biggest changes I've seen throughout my career is a shift in who's participating in markets. It used to be that pretty much everyone who was buying equities was playing some kind of buy low, sell high, which is compare the price to the valuation. And if the price relative to the valuation is low, then you buy it. And then when that flips around and something's overpriced, you sell it. So a valuation-based strategy of some sort or another. Now you've got a lot more participants who are not ever trying to ask the question of what's a fair value for this asset. They're buying it for some other reason. And that could be as basic as index funds, which just come in and buy shares because they happen to be in a certain index. You've got factor funds, you've got risk parity funds, you've got thematic funds. And then two that have really kind of come to the fore in the post-pandemic period, two classes. On the institutional side, you've got what I call bond market refugees. So these are very large investors who would like to, their normal homeland is in the bond market where they can get a nice income and low volatility. But of course, bonds now the price of bonds has been pushed so high that the yield that you get on the bonds has been pushed in real terms to be negative in a lot of cases. So you just, these people are being forced out of their homeland and they become refugees into the equity market to try to get some return from the yield that you can get from stocks.
Kate, I've got to interrupt. I've never, ever thought of a bond trader as a refugee, but I just want to point that out. They don't go well together, but I'm going to use it from now on. I'm going to steal it from you and use it. So go on.
It's the asset allocators who are saying we just can't get the return. We want this return, we can't get it. So you've got these bond market refugees. The other category that's come up is non-price sensitive participants. And the obvious one here are what I call at the retail side, the pandemic punters.
Right.
So we've heard a lot about these in the US, the kind of GameStop phenomenon, the Robinhood traders. And there seems to be a reasonably large cohort of people where they can't access pokies, they can't go to the races, can't go to the casino, but they can buy some stocks. And it's not a sober assessment of price versus value. This is something exciting to fill my lockdown day. So it's a very different market. This is not your grandfather's market.
So can I add another group in? I'm just interested in your take on it. And it's the super funds. And specifically, we're talking about infrastructure assets and the fact that they're all jumping in to buy these infrastructure assets. People like those assets because they're long-term. They have some surety of tenure in terms of contracts and income. So they're not bond refugees. They're not pandemic punters. Are the big super funds, Canada and Australia particularly, buying assets like Sydney Airport? How do they fit into this story?
Well, it is the same phenomenon as the bond market refugees.
Right.
They want long-dated cash flows. So they want a certain degree of certainty. They want a certain degree of income for many, many years. And so then they have to look at these various assets and say, well, if I want to own this underlying asset, would I prefer to own it in the listed environment or in an unlisted space? And the difference between those, of course, is the ability to trade, so liquidity. But if they don't need that, then the difference really becomes just how frequently you mark to market. And so the apparent volatility. So something that is listed on the market is going to be marked to market every day and throughout the day. Something that you own in an unlisted way is just going to be valued twice a year, maybe 4 times a year. And so that's a lot more attractive from the volatility perceptions of their portfolio.
Stay with me, Kate. We'll be back in a minute. I'm talking to Kate Howitt, Portfolio Manager for the Fidelity Australian Opportunities Fund. Okay, so we've talked about fundamentals, flows and valuations. We know about bond refugees now, pandemic punters. Putting all that into the mix, what sectors, what companies do you think are worth investors having a look at over the next 3, 6, 12 months?
Oh, well, look, for the most part, I would say nothing has changed. You're still looking for solid businesses that have a degree of competitive advantage, that can generate high returns, that can reinvest those returns to deliver growth, that have a strong, capable, high-integrity management team who can respond when the world keeps changing. So I don't think any of that changes. For my approach with the opportunities strategy in Australia is to recognise it's a very narrow marketplace. And really my response to that is to say, I want to own the best of all the different types of businesses. Because if you really constrain yourself down, like if you were to say, oh, look, I'm just a high growth tech investor,
Yep.
you're really not going to get that many names on your list to choose from, and you're going to have a very narrow and undiversified portfolio. So I like to look across pretty much all the sectors of the market and see what's the best name in that sector for now. And that means that you can end up with a portfolio that looks quite schizophrenic. Something, I have, stocks that will work really well if the valuations of high growth tech companies continue to be stretched. WiseTech is an excellent business in that regard, a wonderful software company, but, the valuation, it's not triple digit PE.
Yep.
And so I wouldn't want to have a portfolio that was just full of those sorts of businesses. The fund also has a large position in BHP, which of course is on a single very low PE, which is a sign that the trailing earnings have been very high because of the iron ore price. So again, you wouldn't want to have your portfolio just exposed to something that was potentially at peak earnings. So I like to have all the bases covered.
Okay, but even the lesson from that, in a sense, it's a diversification to some point, but you're picking the best of the banks, the best of the resource stocks, the best of oil and gas.
Exactly.
That's the idea of it.
And that changes through time because, for example, if you think about what's the best stock to own in oil and gas, the big factor that's driving through there is ESG and the need to decarbonize. The big change that's happened there in, I would say, the past 12 months is that ESG has gone from being an issue around voting at the AGM to being a matter of competitive advantage.
Yeah.
So if you think about what is the global energy sector going to look like in 2040 or 2050, right? The whole economy runs on energy. So we will have an energy sector, but is it going to be the Exxons and the ConocoPhillips, the kind of hydrocarbon stocks that dominate that global industry today? Or is it going to be hydrogen companies and ammonia companies? And if you think it's going to be the latter, then there's going to be a lot of change. And the future winners in that sector are going to be the ones that will do the fastest pivot away from their heritage and towards these new growth businesses. And so that leads you in the Australian context to a company like Santos, which almost by virtue of a historical accident has become one of the most advanced companies in carbon capture and storage, which will allow it to pivot into producing hydrogen and position it well for this future world.
Okay. Moving away from ESG, one of the big issues facing global markets at the moment is inflation, whether it's transitory, whether it's permanent. We're seeing semiconductor chip shortages, higher transport costs. How do you think that inflation question will flow through the local market?
Yeah, inflation is such an interesting question because pretty much everyone working in financial markets today was not working in financial markets back in the 70s, the last time that we had really significant inflation. Back then, my elder statesman colleagues tell me that, you would run two sets of books for your companies. You would have, your real forecast and your inflation adjusted nominal forecast. I mean, no one's been doing that for decades. Yeah. So in some ways, it's uncharted territory for most market participants. That in itself, means it's not priced in and therefore something to keep a really good eye on. Now, we know, as you said, right now, we've got, transitory inflation from all the bottlenecks and supply chain issues from the pandemic. That's certain in the near term. What's certain in the long term is that we will have, what we're starting to call greenflation, which is so many parts of the global economy that are done in a cheap hydrocarbon-based way are going to have to transition to being done in a more expensive, decarbonized way. So there's absolutely an inflationary impact coming through. The cost of that transition is, at least $100 trillion US. And so if anyone tries to get a return on that investment, then even just those return expectations are going to drive inflation. So the interesting bit is what happens in the middle of those. So are we going to transition from this, kind of temporary bottleneck inflation back to the kind of secular stagnation, prices stay low because there are excess savings, and then later on get a greenflationary impact? Or are you going to find that wage inflation is going to kind of bridge the gap between those two, and we are from here on in a high inflationary period for potentially a couple of decades? That's, I think, the interesting bit is what happens in the medium term.
What do you think will happen in the medium term?
Well, there will be policy implications to come through. But the interesting thing is the fundamental shift that we've had where central banks earned their stripes from defeating inflation,
Yeah.
going back to the 1980s. Whereas now, we've got our own Phil Lowe, who has been agitating for years to try to get some wage inflation come through.
Yeah.
So you've got central banks now who are trying to fan the flames of inflation. Now, they haven't been terribly successful at that. They're hoping to be successful at that, and they're hoping to be able to kind of damp down those inflationary flames before they get too strong. So I think that's the wild card now, is a policy on both the monetary side and the fiscal side is now pushing in an inflationary direction. I mean, who would have thought here in Australia that we would have a coalition government that would do such a deeply stimulatory budget?
Yep,
Quite
incredible.
This is what the pandemic has done, where every fiscal hawk in the world has turned into a dove. And so everything is lined up to push that inflation through.
I mentioned earlier the international recognition you've received, Kate, as a fund manager, one of the top 30 female fund managers in the world. That's 4 years in a row you've achieved that. Just 7% of Australian-based funds, though, are run by women. Why is that, and how do we get more balance?
Oh, look, there are so many factors. It would be great if there was just one switch we could flick that would change that.
Yep.
But there's so many factors. You can go all the way back to high school girls. I hate to break it to you, but the finance industry does not have a great standing with girls who are trying to consider their future career path.
Yep.
The finance industry portrays itself in some ways as, in kind of Wolf of Wall Street terms.
Yep.
And that's not attractive to a lot of young women out there trying to, decide where they're going to devote the effort of their career. So in some ways, we've got to do a bit of a rebranding and explain that financial intermediation helps people solve problems in the community. Doesn't just make finance practitioners wealthy. So that would go a long way. I think the industry is doing a lot better in the next steps of really going out there and trying to actively cultivate relationships with women in their university years to get them to consider careers in finance. But then we've got to do better at retaining them through those critical periods, because the time in a woman's life when she is building up her investment skills and investment reputation is generally going to overlap with those really tricky early family years. So I was promoted from analyst to portfolio manager while I was on maternity leave. And, that was the timing.
Yep.
And if I hadn't have been promoted at that point, then I wouldn't have had the time to build up the track record to give clients confidence to award me mandates. So we've got to do, a lot better job at helping women during that early phase of their career. And then the next big lever is clients have to be prepared to back women, and no one, everyone has to get a first client at some point. And I remember lots of time pounding the pavements, talking to people, telling them my story, telling them what I intended to do with the portfolio, showing them, my track record on a pilot. But I needed someone to finally, once you get someone who'll take a chance with you, then others are prepared to come in. So we need clients to also have a bit of risk taking in terms of who they'll back at an early stage.
And you remember your first client, no doubt?
Oh, I do. And I think of them very fondly.
Kate, thank you for talking to Fear and Greed.
Thank you very much.
That was Kate Howitt, Portfolio Manager for the Fidelity Australian Opportunities Fund. This is a Fear and Greed Daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.